At 1:45 in the morning on Monday, the 15th of September 2008, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection at the United States Bankruptcy Court for the Southern District of New York. The firm declared $639 billion in assets and $613 billion in debts. It was the largest bankruptcy filing in United States history. When the markets opened 4 hours later, the Dow Jones Industrial Average fell 504 points, the largest single-day point decline since the attacks of the 11th of September 2001. Lehman's own shares had already lost 93% of their value in the preceding months. The collapse of a firm that had survived the Civil War, 2 World Wars, and the Great Depression took less than a year from the first serious warnings. But the filing was not the crisis. It was the trigger for the crisis. Over the next 19 days, the United States financial system experienced a sequence of failures and near failures that the 3 men responsible for managing it, Federal Reserve Chairman Ben Bernanke, Treasury Secretary Henry Paulson, and New York Federal Reserve President Timothy Geithner, later described as the worst financial catastrophe since the Great Depression. Bernanke, in congressional testimony, called what they were confronting a cataclysm that could have rivaled or surpassed the Great Depression. Those 19 days are the subject of this account. The crisis of September 2008 did not begin in September 2008. Its origins lay in a decade of regulatory decisions, financial innovation, and institutional behavior that had built a system of extraordinary fragility whilst presenting the appearance of extraordinary strength. The deregulation of the 1990s, particularly the repeal of the Glass-Steagall Act in 1999, which had separated commercial banking from investment banking since 1933, allowed financial institutions to combine activities previously kept apart for sound reasons. Investment banks could now use depositor-backed balance sheets to make speculative bets. Commercial banks could originate mortgages and immediately sell them to investment banks, removing any incentive to verify whether the borrower could actually repay the loan. The result was the mortgage securitization machine. Banks originated mortgages, packaged them into securities, sold those securities to investors, and used the proceeds to originate more mortgages. Rating agencies assigned these securities high grades they did not deserve. The assumption embedded in every model was that house prices would not fall simultaneously across the whole country. That assumption was wrong. By 2006, the housing market was deteriorating. By 2007, mortgage defaults were rising rapidly. In March 2008, Bear Stearns came to the brink of collapse and was rescued, with government backing, by a sale to JP Chase. The lesson appeared to be that Washington would intervene to prevent the failure of a major financial institution. Lehman Brothers took note. Its management continued operating on the assumption that Washington would not allow the firm to fail. That assumption, as it turned out, was the one that killed them. Before we go further, if this kind of history matters to you, consider subscribing to the channel. Every video here is built around the financial decisions that actually changed the world, the crises, the policy failures, the moments when the system revealed what it was designed to protect. If that is the kind of analysis you want to keep watching, the subscribe button is how you tell us, and we want to hear from you. Did you live through one of these turning points? The 2008 collapse, the 70s oil shock, the end of Bretton Woods? Did it change your family's circumstances, your understanding of how money actually works? Leave it in the comments. The most complete record of these events is not in any official report. It is in the people who were paying attention. Now, back to the account. The fate of Lehman Brothers was decided over the weekend of the 12th to 14th of September 2008 in a series of meetings at the Federal Reserve Bank of New York. Lehman had been in visible distress since the summer. Its share price had fallen 60% in a single week in early September after talks with Korea Development Bank collapsed. On the 10th of September, the firm announced a quarterly loss of $3.9 billion and write-downs of $5.6 billion on its mortgage portfolio. It was the second quarterly loss in succession. On Friday the 12th, Paulson and Geithner summoned the chief executives of America's largest financial institutions to the New York Fed and told them plainly, the government would not bail out Lehman Brothers. A private solution had to be found by Sunday night, or the firm would file for bankruptcy on Monday morning. 2 potential buyers emerged and both failed. Bank of America pivoted instead to acquire Merrill Lynch, which was itself facing imminent collapse. Barclays of London was in serious negotiations, but the Bank of England and the Financial Services Authority refused to waive the rule requiring shareholder approval for such an acquisition. The British regulators vetoed the deal. The transaction that might have saved Lehman died not in New York but in London. By Sunday afternoon, the outcome was inevitable. Lehman's employees had already begun arriving to clear out their offices. Legal teams were completing the bankruptcy filing. The largest institution in Wall Street history to face collapse would receive no government rescue. The decision not to save Lehman has been argued about ever since. Paulson said the government lacked the legal authority to inject capital into a failing investment bank without adequate collateral. Critics have never been fully satisfied with that explanation. What Paulson, Bernanke, and Geichner had not fully anticipated was the mechanism by which Lehman's failure would propagate through the system. The first shock came on the 16th of September. American International Group, AIG, the world's largest insurer, had written enormous quantities of credit default swaps, contracts that promised to pay out if mortgage-backed securities defaulted. AIG had collected the premiums without holding capital against the possibility that it would actually have to pay. When Lehman's bankruptcy caused the credit markets to seize, AIG faced calls to post collateral it did not have. The firm was hours from insolvency. The Federal Reserve intervened. It extended an $85 billion emergency credit line to AIG in exchange for an 80% equity stake. The government had just refused to rescue Lehman Brothers. Less than 48 hours later, it rescued AIG, a firm with notional derivatives exposure estimated at $1.8 trillion. The inconsistency sent the markets into further confusion about who would be saved and who would not. On the same day, a second event hit. The Reserve Primary Fund, a $62 billion money market fund, the oldest in the United States, announced it had broken the buck. Its net asset value had fallen below $1 per share because of losses on Lehman Brothers commercial paper. Money market funds had never broken the buck in 40 years of existence. Millions of Americans considered them the equivalent of a savings account. The announcement triggered an immediate run. Investors pulled an estimated $250 billion from money market funds within days, even from funds with no exposure to Lehman. Banks, which relied on money market funds as a primary source of short-term funding, found that market frozen. By Thursday that week, banks had accumulated $190 billion in cash reserves against a normal level of $2 billion. They were hoarding because they trusted no counterparty to repay them. The interbank lending market had effectively stopped functioning. On the 19th of September 2008, Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke walked into the office of Senate Majority Leader Harry Reid and told him that without congressional action within days, the United States financial system would cease to function. Paulson, a former Goldman Sachs chief executive, had spent his career in markets. He understood that the problem was not simply one of liquidity, banks needing short-term cash, but of solvency. The underlying assets on bank balance sheets were worth less than their stated value, and nobody in the market was certain by how much. The only entity large enough to address that uncertainty was the federal government. The proposal they brought to Congress was 3 pages long. It asked for $700 billion and virtually unlimited discretion for the Treasury Secretary to deploy it. Congress could not believe what it was reading. Senator Christopher Dodd described it as stunning and alarming. Congressional leaders demanded accountability mechanisms, restrictions on executive compensation, and oversight provisions. The public had already been told that Wall Street's recklessness had caused the crisis. Now the same Wall Street was asking for $700 billion with no conditions attached. What concentrated minds was the question posed by congressional leaders: what happens if Congress does not act? Paulson reportedly replied, "Heaven help us all." Bernanke, in congressional testimony, stated that without the rescue package, the United States would face a depression. Not a recession, not a downturn, a depression. He had spent his academic career studying the Great Depression and knew from the inside of the data what one looked like. He was telling Congress that this was the same inflection point and that the same mistake, allowing the financial system to collapse, would produce the same outcome. On the 29th of September 2008, the House of Representatives voted on the Emergency Economic Stabilization Act. It was rejected. 228 members voted against it. 205 voted in favor. In the hours that followed, the Dow Jones Industrial Average fell 777 points, the largest single-day point decline in the history of the index to that date. In a single trading session, approximately $1.2 trillion in market value was erased from American equities. The failure of Congress to pass the rescue package had itself become a financial shock. The markets did not care about the political arguments. They saw the legislature of the most powerful economy on earth refusing to act during a financial emergency. What they concluded was that if governments could not respond, the crisis had no floor. 4 days later, on the 3rd of October, a revised version of the legislation passed. It included the accountability provisions stripped from the original. The Senate had passed it first, the House second. President George W. Bush signed it into law within hours. The Emergency Economic Stabilization Act authorized the Troubled Asset Relief Program, TARP, with an initial ceiling of $700 billion, later reduced to $475 billion. Rather than purchasing toxic assets as originally planned, the Treasury used the funds primarily to inject capital directly into financial institutions. Within weeks, the 9 largest American banks had each received $25 billion in exchange for government equity stakes. The crisis did not end with TARP. The Dow continued falling through November, reaching a low of 6,626 in March 2009, a loss of more than 50% from its October 2007 peak. 8.7 million jobs were ultimately lost in the United States. Millions of homes were foreclosed. The global financial system did not collapse in September 2008. The interventions of Bernanke, Paulson, and Geithner, the AIG rescue, the guarantee of money market funds, the TARP capital injections, prevented the complete seizure of the financial system that Bernanke himself equated with the Great Depression. What was saved was the architecture. The banks survived. Credit markets eventually reopened. The Dow recovered fully by 2013 and reached new highs by 2016. What was not saved was the trust. The decisions of September 2008, rescuing AIG whilst allowing Lehman to fail, injecting capital into banks without conditions on how it was used, passing a bailout that asked the public to rescue the institutions that had created the crisis, generated a political backlash that reshaped Western politics for the following decade. The Tea Party movement, Occupy Wall Street, the populist wave of 2016, the anger that produced Brexit, all trace some portion of their energy to the sense, widely held and not entirely wrong, that in September 2008 the financial system was rescued at public expense and the people who created the crisis were not held accountable. Richard Fuld, Lehman's chief executive, walked away with $480 million in total compensation over his tenure. No senior banker directly responsible for the crisis served prison time in the United States. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 attempted to build safeguards against a recurrence, higher capital requirements, living wills for systemically important institutions, new regulatory oversight. Whether those safeguards are sufficient remains a question that regulators, economists, and legislators continue to debate. Ben Bernanke won the Nobel Prize in Economics in 2022, in part for his work demonstrating how financial crises transmit to the real economy. The prize was given to the man whose academic research had prepared him to prevent a second Great Depression, and who had used that preparation in the most consequential financial crisis since the one he had studied. History will continue to debate whether September 2008 was a manageable crisis badly managed, a near catastrophe barely averted, or both simultaneously. What it will not debate is that those 19 days changed everything. If this account has given you a clearer understanding of how financial power actually operates, subscribe to the channel. There are more crises, more decisions, more turning points still to document. And if this period of history connects to something you lived through or something a family member witnessed, the bank runs, the inflation, the austerity, the moment a system everyone trusted stopped working, tell us in the comments. What did they see? What did it cost them? What did they believe afterwards? The official version of these events is always written by the institutions that survived them. The fuller version belongs to the people who did not.